Welcome to Lesson 5 of the Basic Bookkeeping Level 2 course. In this lesson, you will study three financial statements. The income statement, which reports the results of the company's operations for the fiscal period then ended. The statement of owner's equity, which shows the owner's residual interest in the company at a specific point in time. And the balance sheet, which reports the financial position of the company at a point in time. In this lesson, you will learn how to group accounts to make them easier to record on the financial statements, and how to prepare the financial statements. The process you will follow to prepare the financial statements is to post the final trial balance to the appropriate financial statement. The purpose of the income statement is to show how much income has been earned by the business during the reporting period. The income statement represents the matching of expenses for the period with the revenue they helped to earn. Let's study the income statement of XY Consumer Products for the year ending December 31st, 2004. The statement is headed up with the name of our company and is titled Income Statement. The period of operations being reported on is for 1 year, so we use the term for the year ending December 31st in the title. Setting up the three-line title is the first step in preparing the income statement. When you browse the statement, you will notice that it contains 2 years of information: the current year, 2004, and the previous year, 2003, for comparative purposes. You will also note that for this year-end statement, we haven't included any cents and have included dollar signs only at the top of the columns and on the totals in a column. This is done to make the statement easier to read. The procedure we use when we eliminate cents is called rounding. This is done so that the statements are easy to read. For example, if you had an amount of $64,980.55, you would round it to $64,981. And if the number ended in 48 cents, you would round it to $64,980. All amounts that have cents of 50 or more are rounded to the next higher dollar, and all amounts that have cents of less than 50 are truncated or dropped from the amount. Looking at the categories on the left side of the statement, you will notice that we start with sales, and from this, the costs of the goods sold is deducted to arrive at a subtotal we call gross margin, which is also known as the gross profit. Now let's take a closer look at how our final trial balance ties into this income statement. The first item to be entered on the income statement is sales. On our final trial balance, there are 3 accounts that relate to sales. These are sales, account number 4000, sales returns and allowances, account number 4010, and sales discounts, account number 4020. From the gross sales, we must subtract the returns and allowances and the sales discounts to arrive at a net sales amount. This net sales figure is the amount that shows up under the heading Sales on the income statement. The next section on the income statement is the cost of goods sold. When you take your opening inventory figure and add to this the net purchases during the year, this gives you the cost of goods available for sale, less the final inventory, which is the cost of goods sold. A separate calculation must be done to determine the net purchases. Net purchases are calculated by taking the total purchases for the year and subtracting purchase returns and allowances and purchase discounts. To calculate gross margin, take the sales, subtract the cost of goods sold, and the result is the gross margin. Now, please look at the expenses portion of the income statement. Accounts on the income statement are not in the same order as in our final trial balance. The final trial balance has taken the account balances from our general ledger and listed them in numerical order. Originally, these numbers may have been allocated by first arranging the accounts in alphabetical or some other order. Our income statement, on the other hand, is laid out to best present expenses, with small amounts grouped with other accounts that are closely related. The idea of presenting a statement to interested parties is to have one that clearly sets out the operations of the company and is easy to read, without having several small, insignificant amounts listed to detract from the larger items on the statement. Finally, we will total all the expenses and subtract this total from the gross margin to arrive at a net income of $94,998. If the company had any non-operating income or expenses, it would be reported following net income. Taxes, if applicable, may also be deducted to produce an income after taxes figure. In the task, you will practice grouping expenses.